Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. Even though it's summer and many people may be on holiday or on their staycations, markets haven't taken a break. There are some important trends emerging in the dollar and in bonds. We publish numerous articles around these topics, so make sure to read them. And if you have specific ideas you want to share, you can share them on our Slack channel too. And all of these products are available for the price of a few weekly cappuccinos, so make sure to sign up to become a Macro Hive member. And if you're after a higher touch service with trade ideas, models, and access to me and my network, drop me an email on bilal@macrohive.com. I can then tell you more about these services. Now, onto our show. On this episode, I speak with Edward Misrahi. Edward is the CIO and founder of Ronit Capital, a leading emerging market-focused hedge fund. He founded the fund in 2013, and before that, he was the founding partner of Eton Park Capital. Edward started his career at Goldman Sachs, where, amongst other things, he worked for the famous Risk Arbitrage group and later became a partner. Edward is a very accomplished, thoughtful, and engaging investor. So onto our conversation. So welcome, Edward, to our podcast show. Thanks for taking the time out to join me.
Thank you so much for having me. It's my pleasure.
Now, you have quite an interesting experience in markets. You've been on the sell side, you've worked for Goldman Sachs, you've founded some leading hedge funds. So you have a really interesting experience in the industry as a whole. Plus, of course, you've seen some really quite major financial market events, often crises, as these things often are. So I thought maybe we could start with almost like a biographical journey, how you've ended up where you are today. And maybe we could go back to your early days at Goldman and you can maybe tell us just a bit more about what your role was there and what was going on in the world at the time.
That'd be great. I ended up in Goldman after graduate university primarily because I was interested in going to business school, actually, and the financial analyst jobs they were offering at the time, which were new in a way, were 2-year jobs, and therefore it worked perfectly. You could tell people that you were going to business school; they didn't give you a hard time, and it seemed like a really interesting area. I must say, I didn't really know that much about it. I knew it was a very good firm, but at the time, if you wanted to know more about the firm, either you knew someone or you went to the library, got an annual report, and read it. And I can assure you that my due diligence wasn't as extensive as going to the library. And I must say, once I started working as an analyst in investment banking, I really, even though it was brutal, I really enjoyed it. And it made me question whether I really wanted to go to business school. And so got an opportunity over time through an analyst that I knew before, got introduced to the whole world of investing. And I was fascinated by the intellectual things of what he was telling me he was doing. It was at the time, it was more of a special situations, risk arb, pure kind of group. It was kind of a famous group in Goldman because it was a group where Bob Rubin had worked then, etc. And what happened is, just as serendipity happens, at the time, the person who took over the group, Eric Mindich, who ended up being also my senior partner when I left for Eton Park, and obviously an incredible mentor for me, had been intrigued about certain things in Latin America. There had been a situation in Argentina where there had been, and so they literally needed someone that they could trust and spoke Spanish. And, it shows you that sometimes you just have to be a little lucky at the right time, at the right place. And therefore, even though I had very limited experience of being able to do investing, they gave me a job opportunity. And that's how effectively I joined the investment world. And it was basically, they believe very much in, learning by doing. So I did a lot of US situations at the beginning, so I could work closely with the more senior members of the team and learn how to look at spin-offs, mergers, restructurings. And then my focus was then to develop the activity in Latin America. And I did a big trip to Latin America. I went to Mexico, Brazil, Argentina, Chile. Eric came with me for some places. And then I came back, and in good Goldman Sachs fashion, I wrote a 6-page memo. And literally maybe a month after I had given this memo to Eric, who had discussed it with the senior with the senior management, the Mexico peso blew up in December 1994. And literally for the next 2 years, the only thing I did was distress Mexican Eurobonds. And I can tell you that in my 6-page memo, there's not a single word related to Eurobond or distressed. So it can show you how you best plan the strategy one single event can change it. And I think it just introduced me to the fact that the number one thing at least in the, I've always been more an emerging markets, international oriented investor, is you always have to be ready for something really unexpected. You always have to make sure that if something unexpected happens, it doesn't take you out of the game. And that in crises, as traumatic as they can be, and obviously there's the whole social aspect, which obviously in financial markets, we tend to not focus enough on, but it is what it is. It can drive to a lot of opportunities that you may have not thought so before. And so, it was a little bit, but that literally happened maybe a month into my starting to become a Latin America oriented investor. So it definitely has formed, when you grow through these crises, and obviously we can talk about them. I had a series more. It can be forming in that context.
And during that period after the Mexico devaluation, that was, I guess, known as the tequila crisis or the Mexico crisis. That was around them effectively having lots of dollar liabilities, and they devalued the currency and had effectively a currency mismatch. And then eventually, I guess the US government bailed them out in some way in 95.
Yeah, effectively what happened is, you're going to think it's crazy, but Mexico only used to report reserves like 3 times a year. So you didn't know what their reserves were. And they had issued these dollar-linked bonds, which were called tesabonos. And so they had like a peg, but then obviously suddenly people realized that they may have not had that many reserves. There was also political, there was an election, there was at the end, all these things. And then the whole thing is eventually, as you say, the government, it didn't end up defaulting on any obligations because obviously the domestic things they just paid in pesos. And then the US managed to basically structure a line of credit for them with oil as a collateral. And effectively Mexico eventually, well, obviously the impact on Mexico was brutal. And half of, a large portion of the banking system blew up and effectively had to get bailed out. So there was obviously incredible consequences. At the time, obviously, we depended a lot of, the news wires and the press was really the way. And obviously the news wires was Reuters at the time. Bloomberg was there, but not as big. And the papers were important. And I remember that if you read the paper every day in Mexico, in US, and you read things, you literally thought Mexico was about to disappear from the face of the earth. Anyway, so I decided to go. I told Eric, I'm going to Mexico for a week. I'm just going to go and visit companies. And he said, absolutely, anyway. And I went for a few days. And obviously at the time, communications wasn't like now, you didn't have mobile. So I used to call the office maybe once a day. And I remember maybe halfway through the trip, after having visited a bunch of companies and seen the banks, and I saw some government officials, I remember calling back and Eric saying, so how things? I said, Eric, I don't understand. If you read the press in the US, you think this country is blowing up. But I'm telling you, everything is normal here. Yeah, obviously people have to restructure that. But it was the first realization that you've got to remember that countries are not companies and entities and dynamics. And so for me, it was a very, very good lesson on the fact that you can easily build an incredibly negative narrative on the financial situation of a country and the potential blow up. And many times they do occur. But those things are different than just saying this company Y is going to blow up. I think it's a different dynamic. So it was really interesting. It really helped me in my career dramatically because we did well out of a lot of the things that we did in Mexico over time.
And how did the senior guys in the team approach the distressed assets? Because presumably, as you were kind of saying, if you're not so experienced, you'll look at the way these markets are trading, you'll think, I don't want to touch them. Whereas presumably there's guys in the team who are saying, you've got to buy.
I agree. And look, this is where I learned a ton. And obviously working closely with Eric and some of the other guys, it was unbelievable because I remember there was one company I did an analysis of, and it was an infrastructure-related company. And Eric asked me to, walk him through my analysis. And I was still fairly intimidated and kind of young and kind of presenting. And I remember I basically shaded every number down dramatically because I was so worried that he would test me on one of them and I would be off. And so I just kind of, if I knew the number was 8, I would say it was 6, just to make sure that if I was wrong on the 8, I was likely to be wrong on the 6. And I came up and the recovery on this bond was enormous. And so the bonds were trading like at 50 cents. And Eric says to me, oh my God, this is a great buy. And I said, yeah, I guess, but these things. And anyway, Eric said to me, where's the last indication? So I said, look, in the trade sheet I saw, it said there was 50-60. That's where the market was for these bonds. And he says to me, why don't you, let's try to buy some. And, first I was like, I was kind of excited and apprehensive because I was like, great, he wants to buy something I want to buy, but man, we're going to buy it. I could really screw up here and lose my job. He says, why don't you bid? Let's bid. And so he calls the trader up and he says, let's bid 45 for like a few million bonds or whatever it was. And a second later, the trader comes saying, we own them at 45. And my view was like, well, I thought they were 50 to 60. He says, Edward, they're whatever the price is. Those bonds, by the way, went from 45 to like 20. And I would tell you, and then by the way, eventually we nearly got par back for them and all the coupons in the middle, etc. But I think that if I hadn't been with someone who had been used to trading distress where things can move a lot and you have to be pragmatic, and because you have to have confidence that if you're confident on your analysis, the market prices can be mechanism. And Eric obviously had a very good sense that, look, this makes sense to me. All these people bought up these bonds because they thought Mexico was a good story. Now Mexico's blown up. People are desperate to sell. Therefore, the person who's selling it to you is not really telling you that they think that the bond is worth 50 or 40 or 30. They're just saying, I don't really want to have this bond anymore. And if someone is willing to buy it, and it made me a lot of lessons about it. But yeah, I think I learned a ton through the whole process. Obviously, the distress market is very different now, much more sophisticated. But obviously, it was invaluable because at every time, what I could do well at the beginning, what I thought I could do was just doing the analysis, do the questions, and every now and then, every time we would discuss a situation, they would come, there would be questions I couldn't answer, and then I would know how to do it. And I got smarter and more thoughtful about how to ask the questions so I could understand better what mattered. But there's a whole world about trading, understanding motivations, buyers, sellers, dynamics that, you can't learn it in a book. And it also taught me, by the way, that I have more ability. If you had told me then that, would you be comfortable buying something that goes down 50% and you would be able to sleep at night? Because I was convinced they were going to fire me. And I actually realized that I could deal with it. It didn't block me. I was very upset or disappointed at times, and I said plenty of things wrong. But I actually realized that, wow, I can be really disappointed and really bad. But if I believe in the story and I have the confidence of my superiors that they convinces us, I kept going. And that, I think, is also an interesting lesson that you only learn when you're doing, of how you would handle under stressful trading circumstances. Because all of us at any moment of time will deal with them, and how you handle them makes a big difference, whether you can basically separate the emotion of how well you're doing or how badly you're doing from what is the right thing to do at that time. And obviously I had great people, whether it was Eric and there was just another group of, very experienced risk takers in my group and in other groups in Goldman. And, obviously that's where they were successful because they knew how to do that well. And so I had a great area to learn from.
On that psychology of dealing with drawdowns or mark-to-market losses, is that something you feel like you can learn as you go through that experience? So maybe early on you can't cope with it, but later you can learn how to cope with it? Or is it just reflective of your character or your personality?
The answer is I believe that most things can be trained anyway. So I wouldn't want to say that you couldn't, because I definitely got better, I don't know if it's a good thing or a bad thing, but I definitely got better at dealing with drawdowns. As the more you have, the more you get used to them and you live with them. But I do think that there is some part of it that's innate. I think that some people's character struggles with the clear, the market is a very cruel machinery in the sense that if you're wrong, it's telling you right in front of you, with unabashed clarity. And therefore, you can't really go and hide and go and tell, no, I don't think, etc. And so I think that you got to have a lot of your self-confidence to be able to weather being told by the market that you are an idiot, which happens routinely, and be willing to say, you know what, I know the market is thinking I'm wrong now, but I believe in my analysis. I believe in the thing. I think it's going to be okay at the time. And I think that you could definitely get better at it for sure. So you definitely train, etc. I think that I have seen, however, some situations where I think people freeze. And the one great thing I also learned at that time is that there were times where we lost a lot of money in a position, not always mine, and we would sell it right away. And I would say, oh, wow, we don't really want to recover. And he says, no, thesis change, we're out. It doesn't matter. The market, the cost basis is the market price last night, not where we bought it originally, because if we're wrong. And again, that takes a discipline, to admit you were wrong and not other things. And look, at the end of the day, when you've been around for a while, you realize that this game is much more, as people have talked a lot about, and this is not an original thought for me, it's just general. It's more like baseball. It's your batting average doesn't have to be that high to be a legendary investor. You just have to know when you're batting, when to press or not press. And a lot of these great risk takers I learned from just, had a good sense. So, but I think the tolerance of having a big situation that is problematic, I think that if your personality can't handle, there's some personalities I think that, by the way, incredibly qualified people, incredibly smart people, but they struggle a little bit with that.
If we kind of move to the next major emerging market crisis, which was, I suppose, 97, Thailand, and then the Asia crisis. So by then, I guess you had a couple of years under your belt. You'd been working with a great team. How was that experience for you?
But I'll tell you, as bad as much as you would think that, it still partially blindsided us a lot, because the Thailand effect was, we weren't that active in Thailand. And so we, the whole Thai baht breaking, but the whole crisis, Korea, etc. But what happened is that was an issue, but then we never really even thought, because effectively what actually ended up being a bigger issue for us in our group at the time was the impact it had on long-term capital. Because long-term capital was like this big behemoth. It was the big first enormous hedge fund. Well, I mean, except for the macro guys, let's say the Soros or et cetera. And what we didn't realize, because there was less information, is that they had started to get active in all kinds of things, including things that we were active on. And therefore, things started trading in weird ways and everything. So the answer is, I think the Asian crisis, probably I learned there was less, let's say, drama. It was like, it was not really something I was that involved in. It was doing more LATAM and some Eastern Europe. And secondly, it stayed more localized. And then what happened, however, what I learned from it was how a region crisis in one place leads to a sequence of things where something that you would have thought was unrelated suddenly creates another big collapse. And I'll tell you a very interesting situation. In 1998, when long-term was effectively, in hindsight, was unwinding, we went through a period, I remember, where we were just losing money every day. I mean, literally across the book globally. And Eric would ask us to revisit the numbers on every position we had everywhere. And it was just, it didn't matter. We would do the analysis, we would feel comfortable, and then next week we would lose even more money. And we couldn't figure out what was happening. Obviously, in hindsight, after August, when long-term effectively, the whole public thing of long-term became public, and we realized what happened, it's another lesson that I learned from that whole period, is that if something you can't fully rationalize, it doesn't mean that it's just that there's other things happening and you just don't know them. And you have to respect that tremendously. And I think that, again, that was another lesson that everybody with hindsight can always tell you, oh, this happened. But I'm telling you, living it day to day, and it wasn't that easy at all.
Yeah, so I guess that's the case. So you weren't so focused on Asia, you didn't have as much risk to Asia, but that ended up creating correlations and intermarket linkages all the way back to everything, because LTCM, I guess, had trades everywhere. And
by the way, that's effectively, for example, that helped us a lot when I was already at Eton Park, worked with Eric and another amazing group of senior leaders there, partners. And we were relatively early in the sense of identifying this whole issue in the mortgage space and how big the potential mismatch was and how interesting the dynamic was. But I think our insight was better in the sense is that when people were telling us this is localized, it's not our experience. Our experience, if there's a big problem somewhere, it happens to spill in places you have no idea. It's not like we knew exactly that you would have Lehman go under and Bear Stearns go under. But what we knew is that if it's enough scale, you never really fully understand the interconnections. And those things are only gotten more, not less. So, you learn lessons from every crisis, but unfortunately, it doesn't always prepare you for the next one.
But say for the 07 one, so you started to identify issues in the subprime housing market. You think, okay, this could become a bigger, more global issue. Then how do you know which markets to focus on? Like, how do you know which markets are then going to blow up, even if you do have a view of correlation?
It's tough. I think that different situations can lead you. I think that you basically have to try to do some simulations in terms of you thinking in your head, okay, what could happen if this happens, and the second thing happens, and the third thing happens. And I cannot tell you that there's a good cookie cutter. I'll give you an example. Everybody now is very focused on factor analysis and everything, which obviously has become a thing. But when I grew up investing, we kind of knew we were long oil or short oil or But, that was as sophisticated as it got. It didn't get or long rates, because you own some interest rates into it. But I learned it really the hard way because in the late 2000s, we used to have a relatively large book in EM, and it was generally relatively hedged in the sense that we used to run fairly market neutral. But because I was in emerging markets, not always easy to hedge, I used to use a lot of indices as a hedging mechanism. And what happened is I didn't really focus enough at the time, but it created a massive mismatch in our commodity exposure. Because what happened is in the late 2000s, the big companies in EM were mostly natural resource companies, oil, mining. And so when there was the big spike in oil prices and commodities in the late 2000s, effectively the indices did very well, but a lot of companies did badly. And we had this book that was supposed to be relatively risk neutral, performing terribly. And that's one other big lesson I learned. My big lesson from that, apart from understand, I got to understand factors earlier, faster than I should have. This was that gross size, even if you hedge it, is a much bigger risk factor than people think. And sometimes the best way to reduce risk is you have to cut risk, not hedge risk. There are certain things you just cannot hedge there. So, for example, in the financial crisis or in different business crises, we would be more willing to just cut exposures and forget about whether you should be short that thing versus long thing. Just saying, just have less of everything. And that is something for me is a very big lesson I still apply today. Whenever I'm feel a little bit more nervous about the environment or I think the risk is mispriced, the number one thing I do is cut my gross exposure. I don't try to hedge things out. I don't try to buy some cheap optionality because I'm never sure whether how these correlations that we were talking about are really going to work. And therefore, my first option is take the correlations out of the picture, just have less. And I still use that as a parameter again.
And are you more comfortable in certain asset classes? Like, do you prefer trading equities to credit or sovereign?
Equity and credit is the two, and corporate credit is the two things I feel most comfortable with. I spent a lot of time on precious metals in my time at Eton Park, and so I generally feel I have at least a good understanding of the factors that tend to affect a lot of the precious metal matters, which obviously when we talk about the current situation, we could talk about it a little bit more. I would say on more technical macro things like, forward curves, FX, etc. I'm much more of I think I have a view on direction, but I don't try to be too technical on the trading because, it's not something I grew up doing, so I might think that this currency looks overvalued, but I wouldn't want to make that a big trade position because it's not really what I feel good as how to structure the trade, how to make sure you put everything correctly. And so on the macro side, I feel like I have views because it matters to declare things, but I'm more comfortable trading the micro products, the equities, the corporate credits. Those are the things that I feel more comfortable trading.
And then, see, one of the challenges, if you are focused on emerging markets, is the beta to the global factors, to the US or US rates, the dollar, where you kind of think you've got an EM exposure, but there's actually just a global factor. How do you kind of you separate the two out?
What can I tell you? As they always say, to get the EM right, you just have to be not only right on your country, on your sector, and then you have to get the US right. I think you have to respect it, and therefore, how in my environment, I've been in situations where I was not respectful enough about it, and let's say I love the company in a particular place, Brazil, Mexico, Russia, or Turkey, and I said, "Oh, I love the valuation of the company; it's really good," and I don't really care about what's going on in the world because this company is great and it's going to be good. And, and many times I got my head handed to me because I was right on the company, but it was dwarfed by 16 other things going on that were more material, which is why most of us who have lived through emerging markets tend to have a more macro angle, even if we're macro oriented, because you just have to have a little bit of that perspective. Having said that, I think also there's a lot of people, by the way, including me, having made this mistake, that just because you need to think about the macro doesn't mean you should start trading the macro. And it's an interesting distinction. And look, it's a very hard line. So the answer is you have to do it. What I've learned, my approach currently is more that we live in a period now where the biggest job, the hardest part, apart from picking good stocks, etc., is siphoning the enormity of information we receive. And there's high frequency data that you can generate, that you can find yourself. I find it fascinating now how, for example, you've seen all this mobility data analysis that people do with the Google and Apple apps, etc. I mean, some people have been doing that before to track different patterns, and now it's become a commodity. But, a year and a half ago, it was probably something that funds who could do it would have an advantage on. But there's just so much information on anything that, you wonder, it's impossible to process it. Maybe that's why computers will eventually take us all out of business. But the most important thing is, focus on the 2 or 3 things that you think are most important, and then basically treat everything else a little bit as noise. And I'm not being flippant about it. I'm just saying, don't overreact to the day-to-day numbers, because they are a little bit noise in a trend, in whatever trend you have. And so, for example, I'll give you, for me in emerging markets, when people get worried about countries, I always say, okay, but let's see how they rank on my particular trails, which is, I've seen many countries blow up, from Mexico, Thailand, Argentina, Russia, Brazil, multiple times, et cetera. And I said, and generally you need a situation where you have an unstable currency regime, normally a peg, which doesn't work. A funding situation for the country that is unstable. Let's say that your foreign liabilities versus the reserves you have, et cetera, are totally mismatched, or compared to your import and export dynamics, in terms of your ability to fund yourself and be able to get the currency when you need it. And third is the strength of your financial sector. Because what happens is, if your financial sector is weak, once there's stress in the first 2, let's say on the currency, so you have to hike rates, you tend to blow up the financial system, and therefore then you have a vicious circle that generates with all of them going. However, if you think that none of those 3 things are not totally in place, then you realize countries have a lot more ability to withstand difficult periods than people give them credit for. For example, I remember in 2016, or period in Brazil, when there was going to be a change of government because Dilma was very popular, and people were really bearish. People thought countries were going to default, big companies were going to default. And I looked at it and I said, look, the country has a currency that is moving all over the place, but it's moving. Like, it's not like it's artificially pegged at a level that is unsustainable. It's moving. Central bank still has tons of reserves, and if you look at the debt of Brazil, it's mostly local, which means that even if the foreigners abandon them, it doesn't create a, because I think it was 10% more or less of the debt was foreign, so they can manage it. And they've got an unbelievably robust financial system with some of the most profitable banks. So my view was, look, I think the day-to-day news are going to be terrible, but I think they'll weather it. And in a way, basically avoiding the day-to-day news and just sticking to my view ended up being a very profitable view. But you had to have the ability to say, you know what, I know the story today is terrible, but forget about it. The market went down 2% that day, and you have to weather and you have to size. So for going back to your original question, I try to stick to a few macro things that I think are the fundamental ones that are going to be the big crisis drivers. And if those things are okay, then I feel much more comfortable of just going back to the micro work. I'll give you a current example of that. Turkey. So Turkey has some of the cheapest valuations for many things if you look at equities. Some of them are very cheap. And the lira is probably cheap when the way people look at it from a purchasing parity dynamic, et cetera. And they've got a financial sector that is reasonably strong. They've got the private banks are pretty well capitalized, and even the state banks are not terrible. But they've got a catastrophic reserve position. And they've got a fairly large borrowing from abroad, from Europe and from the US, but they're a borrower. That to me scares me, because that means that for one of my 3 criteria, which is the difference between a country that makes and a country that could break, they don't pass the test in 1 of 3. So that means that it doesn't matter how cheap a stock is, I'm just not going to be that interested, because I think that I need to be worried about that particular situation. Whereas South Africa, which is also another basket case in many ways, doesn't have the same criteria. But the answer is, you're right. I think one of the reasons why active management in emerging markets has not generally always done really well is because it's been difficult to trade the things that happen in EM and the macro from the US and everything. And I think all of us have developed our own little niches to try to find a way to do it, but there's no perfect solution.
And one thing kind of struck me when you were going through the different factors was that you didn't mention politics. And obviously politics is a thing that scares a lot of people when it comes to emerging markets. And that's the thing that people then extrapolate to think that it's the end of the world for that country. As an experienced investor in EM, how do you differentiate between politics that you think will end up having an impact on asset markets and politics that won't?
For me, it's all linked to the first three factors I was telling you. I think that if you've got complicated politics in a place where one of the three areas or two of the areas are a little bit weak, then politics can matter a lot because it could be the difference between triggering the problem or not. But in places where the three triggers are not highlighted, I think politics matter for sectors, conversation, but not that much to make money. And look at the situation, for example, look at Mexico. There's this president that people don't like who is, has his own very disruptive ideas. I think the peso has, obviously you have to adjust for oil and everything. But if you were like massively, if you read what people think about him compared to what things happen, you will realize there's very little kind of dynamic about it. Or in Brazil with Bolsonaro or Russia with Putin. So the answer is, I think that you need to track them. Don't get me wrong. You have to be on top of it. But if the country doesn't have a weakness of those three, they're a little bit devoid. And by the way, it's not an emerging market conversation, but I don't think there's a better example of that than the US, where people spend all kinds of times on politics. But at the end of the day, the market tends to be driven more by earnings and, and rates. And every now and then there's like a sell-off or a rally because the politics are going one way or the other. But at the end of the day, and it's because people know that the thing. So I think on EM, you need to understand the politics. I think if you're a private equity investor who's got no liquidity for a long period of time, you may have to be even more focused on those issues just because of the cycle. But in the more liquid markets, you can do it. But I tend to be observer of them, but unless I'm worried about the other two things, I'm more of the view that it's noise more than the fundamental difference.
Yeah. What I've experienced over the years is that people like to talk about it because it's a nice conversation and it brings up people's politics. But if you look at the return on the energy you expend talking politics versus actually studying the fundamentals or understanding market structure, you don't get the return back on all the analysis. As you mentioned, the US situation. I mean, there's so much analysis that's done on that. And then you think, what's the return from that as an investor? It's not much.
No, I agree. Look, I'll give an example. There's other issues. There's issues like, for example, people love to talk about the unsustainability of the debt in China. And I think that they're right in the sense that the path of debt in China and how much we know and how much we don't know is unsustainable because eventually there's got to be someone who pays for that one way or the other. Maybe it's the government business. But I don't think it helps me making a judgment whether I should buy Alibaba. It's a very interesting discussion and things, but it's only going to be material things. It's sort of like, we all know that Social Security in the United States is probably going to be bust sometime in the next decade. But the truth of the matter is no one's really going to care too much about it until, you're closer. So I think politics, I'm not saying it's fully that, but you need to do it. However, it can affect your view on sectors. So for example, in Russia, I've generally not really invested in the oil and gas sector because I feel uncomfortable of my ability to analyze what the particular government at what particular time may decide to do on taxes or things like this. I think so. There's different things that you might do it, but I generally would agree with your view. It's a good topic. It's important, but I think that it probably over discussed compared to the return on economics on from an investment point of view.
And you also mentioned the information overload that we have, the noise and so on. I mean, this is something that's close to my heart as well, and at Macro Hive, we focus on this a lot. What's your process then in terms of managing this? Because presumably you get all this research from the street, you do your own research, you have the news wires, you have signals generated by lots of places. Do you have a process around how you manage this overload?
It probably would be too good to say that I have a very good process, but I have some principles around it for sure. And I'll give you some example. Let me give you a little bit of anecdote, which will highlight you how, at least for EM, we've moved. So one of the things I realized when I was traveling in the early 90s in Latin America and Brazil is, particularly in Brazil, I realized that the local investors, and there's very smart local investors, there's always been, always seem to know things before I did. It was really annoying me. but not insider stuff, just the new stuff. And I was like so annoyed. Anyway, one of the times I'm going there, and I said, and there was a particular situation we were involved, and I had a friend who was an investor in Brazil. And in one of my trips to Brazil, I had dinner with him, and I said, like, how did you know? Like, I didn't know. And he says, Edward, they've been talking about it in the local press for the last week. We all knew kind of something like this was happening. And I said, oh, I didn't know anything about this. So what did I do? I went to our lawyers that we used, and I said, look, please have a paralegal every day photocopy me the business pages of the newspapers and fax them to me every day. And I did that in Brazil, in Mexico, in Argentina, okay? I'm telling you, I knew things in New York before people knew, because there was no confidence. It's because it used to take maybe 2 days for Reuters to write an article about something. So my approach tends to be that whether I'm investing in a company, I've always stressed with my analysts that there's always, there can only be 2 or 3 reasons why we own a stock or we're short a stock. Of course, I can make you a very nice presentation showing you the 26 reasons why it's unbelievably attractive. But at the end of the day, there's always 1 or 2 that are the main drivers, and everything else is things that can make it better. But if they don't, the first two things. And I said, anything related to those 2 factors, I want to know everything is going on. And the other ones, don't confuse me. And so I try to do that in general, which is in terms of everything that we care out of the portfolio that I care, try to think about the 2 or 3 things that are the most important things, and then be very focused on getting information on those. And that means that sometimes I get it from specialized people. And on the other stuff, I generally, look, we have a lot of exposure, let's say, to Brazil, and I might get 10 emails a day from sell-side firms telling me about the latest inflation number, et cetera. And most likely I won't read them. Not because I don't think they're doing well, it's just, it doesn't really matter. And so I don't want to crowd my process tends to be to try to funnel the things. There are definitely some people I read more than others. So there's some people, especially kind of in the dynamic, in the context of it. But I wish I could tell you it was unbelievably systematic.
It's almost like a very extreme sort of decluttering process you're always going through.
Yeah, exactly. And by the way, do I miss some things as a result of it? I'm pretty sure I do. But do I make, on average, better decisions by not having a decluttering on aggregate? I think I do. There's obviously a cost to doing that. Don't get me wrong. There's obviously things that you could have picked up if you had read that report or you had followed up on someone who sent you something regarding something. So don't get me wrong. Of course, there is things that you miss out because of that.
And if we kind of fast forward to our here and now, we're obviously in this COVID world, markets have rallied probably much more than people would have expected, given that we're in a global pandemic. Right now, this is, we're coming into August of 2020. How are you kind of looking at the world at the moment?
So I think the financial markets, I think, have become, a lot of people talk about decoupling. And I do think that effectively the framework for analyzing financial markets and the framework for analyzing the economics outcome are different right now because of the enormous intervention that you have from governments and central banks around the world. I would say that the first thing I would tell you is I think you've got to take it first with an incredible amount of humility that we have seen different pockets of things before. We've seen this before. We've seen that before. We've seen this before. We've never seen them all together. And you and I are used to seeing a country blow up or a country having a crisis, but we've never seen everybody at the same time and on top of it interrelated because of globalization. Just saying. And so I think you've got to be a little bit humble about saying, you know what, I don't really know. And as a result of it, for me, the number one thing is I don't think this is a time to be running aggressive risk, because I think that there's too many things we don't know that if they happen, you can't really say anymore you were surprised. For example, I'll give you an example. If, let's say, I hope not, by the way, Corona turns out to be that, it comes back even stronger in a month or something, because whatever, it has a mutation that, whatever, something totally random. And therefore, we're back into a bad situation economically. You can't really say, oh, I didn't think that could happen anymore, because it's one of the possibilities. I'm not saying it's a high probability, but so not planning for that, it's somewhat irresponsible because you have to be sure. So I think that I would say that obviously the lockdowns and the degree of the lockdowns surprised me in terms of how aggressive governments were to shut things down. I didn't think that was going to happen. And I'm reassured that a lot of those have already been released a lot. And on top of it, that generally people think that that's not a good solution for the next one. But I am worried that I don't see enough signs I think right now anybody wants to be a cheerleader. We want things to get better. Oh, we've seen the worst. We want to, everybody wants to be positive, because in periods of crisis, you don't want to be the person who's like the negative person. You want to be the person who has hope and expectation. And don't get me wrong, I have certain confidence that we will make it through this, but it could be that it's 2 years, not 6 months. And if you take the exception of China, which I think economically is always a different country because they do things differently because of the political considerations, I worry that we had the big collapse, which thank God then has recovered, but now we're going to stall. And it's really hard to get out of the stall, because a lot of the engines that in the West we were used to get out of stalling, which is, get people to do more, travel more, consume more, etc. Those are the ones that are blocked because of the health considerations. So I am worried about the economic outlook. My expectation is that it's going to be weaker than I think the refreshed expectations are. It's probably still going to be better than maybe when people thought at the bottom of the crisis, when the end of the world was coming, but it's still there. And I worry that the financial support that we've had from governments and central banks were in massive lower, impact. When the Fed came in March, the market was in panic. The market was crashing in the credit markets. A little impact from the Fed had a huge impact because, at the end of the day, look, they haven't even had to spend that much money and the credit markets have been thriving. I think now you're in a situation where for them to really make a difference, I don't really know. They can just keep it. And so I'm more cautious because I think that we've seen a lot of the good things that the authorities can do, but we haven't really fully assimilated what the economic conditions are going to be. And overarching all this is, I know that people now worry is there going to be, and from an EM point of view, I would say to you that although people think that obviously the health crisis has been very bad for EM, and it has been, because obviously you've had horrible numbers in many of the EM countries and et cetera. Basically, EM countries, when rates are zero, don't tend to get too much trouble, things. So I'm actually probably a little bit less worried about them. But the other thing I would tell you is that I'm very interested to know, because for the moment, every QE I have looked and analyzed has always effectively been, from an inflation point of view of consumer goods and the inflation of the world, has been deflationary, whether it was Japan or whether it's Europe, UK. Now people think that because of the fiscal spending and the QE, maybe we'll get inflation. I don't know. I must say I'm not convinced at all. It could be. There's a lot of uncertainty, which means I think you should run risk lower, not higher, which is why I'm worried about how people positioning is in markets, because I think people are too exposed. Secondly, a lot of uncertainty. By the way, that doesn't mean that the worst outcome is going to happen. I don't believe necessarily that a bad outcome is going to happen. I just think that there's more options. And so for me, I prefer to be a little bit less active in the market, and I'm probably a little bit more intrigued about some of the things in EM now than I've been in the top, because I think that they've probably passed the worst and they could benefit from the lower rate environment.
And do you have certain emerging market countries or regions you like? Earlier you mentioned South Africa.
Yeah, I would say look some things in Africa. I would say in credit space, for example, I like some of the places. I think some emerging market debt, both at the corporate and even at the sovereign level, especially supranationals, companies that are owned by their governments, et cetera, I think that the yields you're getting are disproportionate to the credit risk you're taking versus where credit spreads are. I believe that if I get 7% in dollars on an ESCOM bond and people are getting 1% on Italian 10-year bonds, I feel like, no. I understand, by the way, why it's there. Don't get me wrong. I'm not saying that, it's because the ECB is buying, et cetera. But from a credit risk point of view, I'm like, no. That's, I'm happy to own the ESCOM bond. So I think that there is some part of the debt profile that I actually think is interesting at these levels. I think that the place where economically you will feel more comfortable, which is China dynamics, the only problem we have is we have an enormous amount of what I would call political uncertainty that is unanalyzable at my level. What do I know? I'm sure you have opinions on what you think is going to happen and other people, but what do we really know? What President Xi and President Trump might do at different times. So I think that, etc. I think LATAM is probably a better place to be now, because if China continues to do what it's doing and commodities remain stable, that, low rates and good commodity prices, generally Latin America is okay. So I'm probably a little bit more intrigued about that. I am worried about Turkey. And I think Eastern Europe is a little bit, and Russia is a little bit, look, I think Russia has many things that are going for it, obviously, but it's another country that is, there's geopolitical aspects that are random, and you have to be a little bit careful. So the answer is, probably if you ask me more, I'm probably more LATAM. I feel like more, but if you ask people, most people are more bullish on Asia because they feel more comfortable on the Asian dynamic. But I think that that's in the price. I just think that markets are smart. They move in the context of it. But overall, I am more of the view that this is a time to be cautious, because we have this too many moving parts, especially in the field of how the economy will interact with the health crisis.
That's great. I think we've covered a lot of ground. Is there anything we missed out that you wanted to share?
No, as I said, no, I think you got the feel that right now I'm a little bit more defensive. And I do think this crisis has components of all the crises I've seen. But because they're all together, I don't really, remember when we're talking about the Asian crisis, long-term capital and everything, I'm not smart enough to understand all the different concepts, but I'm pretty sure they're going to be, and we're going to see them little by little, because some of them are brewing now, but we just don't know. I will tell you one thing that as the last anecdote, I was amazed when you see what happened to oil prices in the first quarter or whatever, when we had that collapse in oil prices, that there's only one situation that one company really had a problem. There was some trading firm in Asia. I just think, because to me, whenever you have big market moves like this, there's problems everywhere. You just don't know yet. And I still think over the next 6 months, you might still see some of those things happen.
Okay, no, great. Well, thank you very much, Edward, for that. Much appreciated. And hopefully we can do this again at some point in the future.
My pleasure. Thank you so much, man, and good luck with everything, and stay healthy.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.